Welcome to today's Explainer. Have you ever wondered why some companies report absolutely massive sales, like off the charts revenue, yet somehow still completely run out of cash? It's a wild paradox, and honestly, it's one that has brought down countless businesses. So let's dive into this by exploring Chapter 3, Financial Statements, Cash Flow, and Taxes. We're going to look at this entire concept through the lens of a real-world Philippine business scenario. By the end of this, you'll understand exactly how financial statements help managers make those crucial life-or-death business decisions. Here is our roadmap for today. We'll start with a corporate expansion mystery, move on to analyzing key financial statements, and then track the cash flow. After that, we'll do a free cash flow analysis, look at how taxes impact corporate finance, and wrap things up with your final essay question. All right, let's jump right into part 1, the corporate expansion mystery. Let me introduce you to Bring Him Home in a Jar Corp. They are a fast-growing Philippine business, but things aren't going so great right now. Listen to this quote from board member and major investor Suniso Pijalat. He is furious. He's saying the cash position is weak, suppliers are paid late, the bank is literally threatening to cut their credit, and shareholder wealth has been destroyed. You see, the company just went through a major expansion, yet instead of celebrating, they are staring right at the brink of disaster. So how in the world did this happen? Well, let's look at the timeline. Flashback to 2020. CEO Mary Grace Piatos and Business Development Officer Don Piang proudly initiated this major nationwide expansion. And at first, it looked great. By mid-2021, Operations Manager Antonio Pagong had successfully built out all the physical assets. New facilities, fresh equipment. But he also noticed something alarming. Cash reserves were just vanishing. Fast forward to late 2021, and the banks are threatening to cut off credit entirely. Now it falls squarely on Fiona, the finance manager, to untangle this massive mess.
That brings us to Section 2, Analyzing Key Financial Statements.
Before we dig into Fiona's numbers, let's quickly refresh these core definitions. Think of the balance sheet as a photograph. It's a snapshot that tells us exactly what the company owns and what it owes on one specific day, like December 31st. The income statement, on the other hand, is more like a video recording. It summarizes revenues and expenses over a given period, showing us the entire flow of the business throughout the year. Okay, look at this simplified balance sheet. This incredible jump tells a very dangerous story. Net fixed assets nearly tripled. They went from roughly 344,000 pesos to over 939,000 pesos because of the expansion. But how did they pay for it? Well, check out total current liabilities. They ballooned from 481,600 pesos to a staggering 1.65 million. They essentially funded long-term assets with massive amounts of short-term debt. And then we check the income statement, which highlights the ultimate paradox here. CEO Mary Grace Piatos and her team did exactly what they set out to do. Sales almost doubled. They leaped from 3.4 million to over 6.1 million pesos. That should be great news, right? But look at the costs. Operating costs absolutely skyrocketed, and their interest expense basically tripled because they took on all that new debt. So what's the final result? A net loss of 160,176 pesos. Think about this for a second. They sold twice as much product, but they spent far more on operations and interest than they actually took in. It's a harsh reality check. Growth absolutely does not automatically equal profitability. Let's move on to Section 3, Tracking the Cash Flow. As our finance manager Fiona knows, the statement of cash flows is vital. Why? Because the income statement includes non-cash items, like depreciation, which can kind of muddy the waters. The statement of cash flows strips all those accounting adjustments away. It shows us the actual hard movement of cash in and out of the business across operating, investing, and financing activities. So Fiona runs the numbers and finds something truly terrifying. Despite borrowing hundreds of thousands of pesos in external capital to fund this big expansion, the company's ending cash balance violently dropped down to a mere 7,282 pesos. They are literally running on fumes right now. I want you to pause and think about this. With only 7,282 pesos left in the bank, what is actually happening on the ground? Operations Manager Antonio Pagong is out there, likely facing some very angry suppliers. But what does our financial data tell us about the situation? Well, the numbers don't lie. Accounts payable shot up by an incredible 260% over the past year, while sales only grew by 78.5%. This is a huge red flag. It proves the company isn't paying its bills. They're effectively using their suppliers as a desperate, unauthorized financing source. And the immediate risk here is fatal. If those suppliers cut off trade credit, operations will instantly grind to a halt. Now, here's another think about this moment. What if marketing manager Timon Andrew Pusa tries to boost those sales by offering customers 60 days to pay instead of the usual 30 days? Sounds like a good way to win customers, right? Actually, scratch that. It would be a disaster. In the short run, accounts receivable would massively increase, meaning physical cash coming in would decrease even further. To survive that, Fiona would have to secure even more external financing. And remember, the banks are already threatening to cut them off. Let's dig deeper in Section 4, Free Cash Flow Analysis. To really understand the company's health, we first need to distinguish between net working capital and net operating working capital. NWC includes all short-term accounts, but NOWC, that removes excess cash and short-term debt, like notes payable. This is absolutely crucial because it gives you, the financial analyst, a much clearer picture of the capital strictly tied up in day-to-day operations. It's the real working engine of the business. Which brings us to arguably the most important metric for investors: free cash flow. Listen, this isn't just leftover money. It's the actual cash available to be distributed to investors, both creditors and shareholders, but only after the company has made all the investments in fixed assets and working capital necessary to keep the lights on and sustain ongoing operations. When Fiona calculates the free cash flow for 2021, the result is pretty grim. It is massively negative, negative 744,564 pesos. This wasn't just a slight miscalculation. This was a severe drain of resources, driven by those heavy, debt-fueled investments during the expansion. And because of these dismal operational results, the market value added, or MVA, plummeted to negative 267,592 pesos. MVA simply represents the difference between the market value and the book value of the firm's equity. So guess what? Investor Suniso P. Balat hit the nail on the head earlier. Accounting statements aside, the MVA is negative, which means true shareholder wealth has absolutely been destroyed here. Now for Section 5, Taxes and Corporate Finance. You can't talk finance without talking taxes, because they heavily influence corporate decision-making. Notice here that interest paid on debt is generally tax-deductible for corporations, while dividends paid to shareholders are not. They come straight out of after-tax income. This brilliant distinction explains exactly why Don Pyong and the executive team might have heavily favored taking on massive bank debt over issuing new stock to fund their expansion. Debt creates a tax shield. However, as we just saw, too much debt completely suffocates cash flow. Fortunately, thanks to tax loss carryforward, the company can carry this year's massive losses forward to offset taxes on future profits. Well, assuming they survive long enough to actually see profits again. Which brings us to our final section, your student essay question. Here is your final assignment for today's explainer. I want you to imagine you are Fiona. The board of directors is sitting across from you waiting for your verdict. Using the data from the balance sheet, the income statement, those frightening cash flow trends, and that massive negative free cash flow we just analyzed, evaluate the company's readiness for further expansion across the Philippines. Can they handle it, or do they need to aggressively restructure right now? Write 250 to 350 words supporting your argument with the concepts we learned today, and post your expert analysis in the comments below. Before you start writing, ask yourself this one final thing. Is aggressive growth a measure of success, or is it simply the fastest way to bankrupt a profitable idea? I really can't wait to read your insights. Keep analyzing, keep learning, and I'll see you next time.